This is Think Smart with TMFG, the weekly podcast of what's newsworthy and relevant to everyday Canadians. I'm your host, Senior Financial Advisor Mike Connon of CI Asante Wealth Management. Welcome to Think Smart with TMFG. I'm Mike Connon. Beside me is John Iaconetti, Financial Advisor with CI Asante Wealth Management. So, John, when people think about estate planning, they usually think about a will. Is that the whole picture?
I mean, not necessarily. A will is important, but what's often surprising to clients is the tax side that happens to maybe your RRIFs or property when somebody does pass away. This becomes more relevant as more families enter this stage of planning, whether they feel they're ready or not. So today, maybe we should expand a little bit on why estate planning goes beyond simply creating a will and the tax implications that can come with it.
I guess at the end of the day, estate planning isn't really about documentation. It's making things easier for the people in your life. The taxes, the accountants, the properties, they all continue after you're gone. Everything, when you go, everything doesn't disappear off the face of the earth.
Exactly.
And that's when the transition happens. And you want to make that as smooth and with as least amount of stretch as possible going through all of your loved ones. So, John, when we talk about estate plan, what does it include?
So wills is a part of it. But when you start thinking about when you pass away, there's a lot of other maybe tools that you can utilize to help that estate as much as possible. So think, well, first, if you pass away and in your will, you list an executor. So there's going to be executorship, and that's going to be the person who actually is going to be the one who helps distribute the assets the way you'd like to have them distributed. But then in addition to that, there's other tools beyond the will that could be of assistance for you. Think beneficiary designations. A lot of registered accounts that you may have, maybe even insurance policies could have a beneficiary designation listed as well. And really all of this is going to be coincided to help coordinate and minimize as much tax possible payable that would be occurring within the estate.
So let's dig down on this a bit. Right? Let's get a little bit deeper. We'll start off with, we see a lot of wills come through and they can be extremely simple from a few page document. Legally, you can actually write a will out in your own handwriting and sign it, and it is valid.
Yeah.
It's called a holographic will. And unfortunately, we've seen a few of them over the years. I don't love when they come in because they're not the greatest way to do it. But I remember one lawyer told me there's a museum of lawyers, believe it or not, in Canada.
I can't imagine anyone who wants to go.
It has the fender of a tractor where someone scratched in their will and their last wishes and signed it. And they died after that, and it became legally binding. Because that's the laws in Canada. So that's one story I heard. I don't know if it's fiction that someone told me or real, but supposedly that's the case. So that's the most simple. I mean, the most simple and most complicated one is not to do a will. Mm-hmm. And some people, too many people choose to go that way.
Yeah.
And although it's simple for the person who dies, it's very complicated for the people who have to inherit the estate. You go from that level to people writing their own wills, then you start to get into the level of lawyers you need.
Yep.
And people ask me, how much does it cost to create a will? It's a very tough question. I see them going from $400 or $500 up to $10,000, $20,000, depending on the complexity in the situation.
Yeah. I always tell people the further you are from the CN Tower, the cheaper it becomes.
Yeah. It's definitely related to location. And also if you have a big estate to protect, that gets complicated. Mm-hmm. If you're on a second marriage, that gets complicated. If you have a corporation, that becomes complicated. So each one of those things adds a different element of complexity to the wills. Mm-hmm. Then you get and start to talk about executors. And then this is another thing that we see. Usually a will is a document. I like to say when you do your will, you do it to last you through the rest of your life. Whenever you create it, it should get you through your entire life.
Yep.
But again, things do change along the way.
Of course,
and you can make changes. There's something called a codicil in a will. Codicil is a change to anything in a will. One thing to warn people, most lawyers do not like to do codicils to other people's wills.
Yep. And
the reason why, if you think of it from a point of view, whoever writes the codicil is responsible for showing up in court. And a codicil is a little document. So for $100, a lawyer doesn't want to take the risk of being in court on something they never got paid on, which is reasonable.
Yeah.
So if you want to make adjustments and your lawyer is no longer available, you're probably going to end up doing a new will along the way. When you look at your executors, this is the thing that does sometimes change. When you have young kids, you may choose, some people choose their parents as executors. Some people choose siblings. And when the kids get older, you have your kids, or if you have close friends. The parents is something that generally I find if they can avoid using parents, you should avoid using parents because that's something that will need to change rather quickly unless there's some type of catastrophic event, which creates an early death or something like that. But a lot of times people put the parents in because they think, oh, my parents are responsible. But their parents are,
Are
70
getting
years
up
old
there
at
in
that
age.
time.
Yeah.
And 15 years later, their parents are 85. Does an 85-year-old really want to deal with an estate?
Yeah. I think a lot of people don't understand even the degree of work that goes into settling an estate. To your point, an 85-year-old having to go through all that paperwork, maybe you have to make different appointments, go to the banks, things like that. It's really not feasible. And that's why to your point, the younger you go, at least that executor has a longer runway, I guess, in terms of how long they could be serving as your executor.
Yeah. When my clients are sitting around and they're saying, I don't know which child to choose as my executor, I say, which would you like the least?
Yeah, exactly. Who do you want to punish?
Yeah, who do you want to punish? Make them the executor because there's no fun in it and it doesn't give you any advantage or anything like that. It's generally a lot of work.
Yeah. There was also one additional point there, maybe not necessarily listing executors, but you mentioned those with minor children. Another part of the will is even selecting guardianship. Who's going to be the one to take care of your children? That's something that absolutely you should at least start having the foresight of thinking that through.
And not even when you have kids, if you're thinking of having kids, because you don't know what's going to happen. We've unfortunately seen some stories where people passed away before their kids were born. And you need to make sure that that's taken care of from the time you're starting to think, okay, I'm going to start to eventually create a family.
Yeah.
You need to have that will created. Other things you have in here, tax coordination. And that's where you have accountants and financial advisors that should work together to structure things, to make sure it's going to go through in a tax effective manner. And from the simplest thing like beneficiary designations, those things don't even fall through the will. But again, you can say probate fees. You got to make sure your spouse, if you have a spouse, is designated beneficiary. These are really simple things, but sometimes missed.
Yeah. And that's why even with our clients, like when they have that preliminary conversation with their lawyer, we get them to bring us the draft of the will that they're planning on doing, create a visual representation of it, and just walk through it with them. Is this the way you wanted to have it set up? Because a lot can get lost in the legal jargon within a will. Sometimes you just need to look at the picture and see, okay, is this actually what I want?
Yeah, we had notes that said, legal preparation does not necessarily equal a financial strategy.
Exactly.
Because you have a will done, that doesn't mean everything is going in the right manner. The next thing to go is how CRA treats things when people pass away. I always tell people everyone's last words are the same. It's sell everything, right? So no matter what happens, the CRA doesn't care what happened to you. Your last words were sell everything, as if you made a fire sale on the minute you passed away. Between spouses, it's very easy. If there's one surviving spouse, everything just passes over pretty much in a tax-free manner. If you don't have things jointly owned, you may have to deal with some probate issues. But other than that, things pass through relatively simple. But when the last spouse passes away, or if it's a single person, capital gains get triggered on a lot of things, on almost everything basically. Yeah. Your investments, you think you have your cottage and your cottage going to the family. No, your cottage is considered sold that day. And all those taxes that they talked about, capital gains, are due. Your house is nice because it's a principal residence. You don't have to pay tax on it. But again, it's considered deemed disposed of that day.
Yep.
And from the day you die, technically speaking, everything you own becomes a trust. And then it is no longer taxed in your rate. From the day you died, that's when your tax year ends. And that's it. You have to file a tax return from everything in that year. Afterwards, the tax is a trust return. And any growth or any type of increase in there are part of that estate trust.
And I mean, taxes can count and become fairly significant overall. I mean, we talked about the different types of accounts, but RRIFs, for example, that would be primarily in the form of income. But in addition to that, it's the capital gains on the cottage, capital gains on your investments. Oftentimes people end up dying with a bigger tax bill than they do have while they're living.
Let's talk about some of the shocks that people get. RRSPs or RRIFs or LIFs or anything that you have like that are fully taxable upon death. Most of our clients talk about trying to keep below that old age security clawback, and they live in that range of taxable income of being, $60,000 to $90,000, try to keep it on their tax return in that area. All of a sudden, when they die, if you have $1 million in a RRIF left over or an RRSP, guess what? That entire $1 million gets added onto your final tax return. And because we're in a marginal tax rate system, once you're over $250,000, you're at 54% tax. So all the tax doing that is an incredibly large tax bill.
Nobody ever wants to pay taxes, so everyone does their best throughout retirement to keep it as low as possible and as low as possible. Well, you're just kicking the can down the road and creating this tax bomb when you do pass, which is unfortunate.
What can we do about that?
Well, there's strategies that you can utilize where paying taxes isn't necessarily a bad thing, but just having the foresight about it and maybe taking money from your RRIFs, maybe more than you need to keep yourself below an old age security clawback. Maybe it means you pay 35% on the money today to avoid paying 53% when you pass. It does all depend on your goals, right? If you do want to pass on that money to the next generation, a strategy may work for you. If you don't have anybody to pass that money on to and frankly don't care whether you pay tax to the estate, maybe that's not right for you. But knowing what your options are is the more important thing.
If you have like a family cottage, why don't we just give it away beforehand?
Oh, in a simple world.
A simple world.
Life's not that
Just
simple.
give it to your kids beforehand.
But then you go deal with the kids themselves. I mean, if you have 3 kids, and oftentimes we run into this problem with clients all the time where maybe they have 3 kids. One of them's actually in province, actually wants the property. 2 of them are maybe outside the province, don't even want the property at all. It creates this bit of a divide and rift in terms of ownership.
It very rarely works.
Yeah.
And the other problem with giving it away too is it's still taxed.
Yeah, that too.
So it doesn't avoid the whole tax. You may be able to do it in a bit of a lower tax bracket than when you finally pass away, but not much, because pretty quickly with the capital gains on these, they run you back up the top tax bracket anyway. So if you give it away, you're deemed a disposition, you're paying the tax anyway. And yeah, as you said, it's not only your kids working together, it's their spouses and their kids all being a big happy family, living in one place, sharing expenses. In some utopian world, it may work. And every grandparent's dream is that everyone goes and frolics in their gardens and enjoys everything they had at the cottage. But it's not a reality.
Yeah, it becomes pretty difficult overall. It's the qualitative factors, I think, that people don't really think about. From the financial side of things, our number one objective is trying to determine, okay, what are those tax projections now going out into the future? Identifying the problem before it actually happens, and then determining a strategy and how to best fix it.
It is one of the things that's great with financial planning software. You can really take a look at the future and see what those taxes are going to look like and put a plan in place. Also, you're an insurance expert in our office, and life insurance probably plays a very important part in all this.
Oh, absolutely. Having that foresight of understanding what the potential tax bill could be. You can get a life insurance policy today that maybe is going to cover that tax bill and be able to, pass on the full value of your estate without getting the CRA involved to the next generation.
It's almost like the light inside of there is insurance, because everything else has these terrible things attached to it.
Exactly.
I'm leaving my cottage. Oh, that's going to cost me money. Yeah. It's my RRIF account. That's going to cost me. I have unrealized capital gains. Oh, that's going to cost me. The only thing whenever I have to deal with the estate, someone passing, well, we have life insurance. I go, what's that going to cost me? Well, it's nothing.
Yeah.
Well, how long is that going to take to get? We'll fill
right away.
You get it right away. And it's an easy thing that goes directly to the beneficiaries without any tax consequences, without any probate, or without any delay. So there's a real value to insurance from an estate planning point of view.
And the other part of that too that a lot of people don't consider is just the fact that you're able to generate this great deal of liquidity. There's a lot of people in Canada now that a lot of their net worth is tied up in the value of their home. Maybe it's a cottage. And oftentimes when people pass, maybe they don't want to sell that asset.
It's all I hear right now. Everyone's trying to sell houses and they're like, I don't want to sell the house. Look at what happened to the value of it. And with an estate, the taxes, if you have a house in the cottage, you're going to have to pay the taxes somehow.
Exactly.
Something's got to be sold.
And the life insurance could just be that saving grace for you and help you pay the tax bill.
So let's do a recap of what we talked about. An estate plan is more than just having a will. We discussed that. A will outlines your wishes, but real planning, considering taxes, account structures, and how assets actually transfer to your family is very important. Many assets are taxed at death as if they were sold. Don't think because you have long-term assets that are going to pass to your family, there's not going to be tax due on them. RRSP and RRIFs, they can create a significant tax problem. Cottage and investment can often carry hidden capital gains that you never think about when you're living and enjoying the place. They can be a heavy tax bill at the end. And planning early creates clarity for families. So the earlier you start this planning and figure out where all this stuff is going to go and how to make it pass through efficiently, the less stress you're going to put on your family later on.
A lot of people reach this stage and think, I've done most of the right things. I just don't know if everything is connected. And that's usually the real gap. Not necessarily the will, but the coordination of how the investments, maybe your RRIFs, properties, when they come together, when the time comes. Even just seeing the numbers once can create a lot of clarity. So if you're listening and thinking, I probably haven't looked at this in a while, that's completely normal. Start with a conversation. You don't have to solve everything all at once. We hear this from a lot of clients who feel that they've done most of the right things, but aren't sure how everything is connected. And that's where the gap is. Not the will itself, but how the investments, RRIFs, and maybe some of the properties come together when the time comes. If you'd like help doing that, you can book a meeting with us. There's a link in the show notes, and we can simply review how everything fits together and identify any gaps worth addressing.
Thank you very much. And that brings us to the end of another episode of Think Smart with TMFG. Thank you for listening to the Think Smart podcast. I'm Mike Connon with the McClellan Financial Group of CI Asante Wealth Management. Don't forget to subscribe to Podbean, Apple Podcasts, Spotify, or YouTube, and leave us a review. For more insights and resources, visit tmfg.ca or follow the link in the episode description.
This program was prepared by Michael Connon, who is a senior financial advisor with CI Asante Wealth Management Limited. This is not an official program of CI Asante Wealth Management Limited, and the statements and opinions expressed during this podcast are not necessarily those of CI Asante Wealth Management Limited. CI Asante Wealth Management Limited is a member of the Canadian Investor Protection Fund and the Canadian Investment Regulatory Organization. This show is intended for general information only and may not apply to all listeners or investors. Please obtain professional financial advice or contact me at 905-771-5200 or visit tmfg.ca to discuss your circumstances prior to acting on the information presented.